So very good evening everyone. So today in this first lecture we are going to discuss about certain important basics with regard to the chapter dividends impact and the cash flow analysis, merging the concepts of time value of money. So first, question number 1 that comes: why this chapter is the question number 1. First thing that I will answer for this question is, always financial management is about how we are going to analyze the cash flows. Cash flows is the one of the most important component which financial management analyzes, due to one good reason. Wealth to a company will come from the cash flows the assets generate. Okay, so the wealth to the company will be quantified using the cash flows. That cash flows will come from the assets of the company. Therefore, wealth is one analysis, cash flow is one analysis, asset is another analysis. Three different points are covered in financial management. Cash flow from the assets will create the wealth. Maximization of the wealth is the objective of financial management. That can be either a basic financial management, that can be even advanced financial management, being the strategic financial management, what we are going to discuss today. So let us understand one very important point now. So first one, why this chapter? Simply, value of asset is present value of its future cash flow discounted at a required rate. Present value of its future cash flows. If you observe this word, it's very clear. We are going to calculate the value of an asset on the basis of the future cash flows it is going to generate. Unless and until we have this, we can't get the value of this asset. So the value of asset is present value of its future cash flows discounted at required rate of return. Now I will analyze more into this. We can draw an asset triangle. How it look like? Let me explain. See here. There will be three different angles for an asset. If this is a asset, three different viewpoints will be there. Number 1, the cash flow the asset gives. Number 2, the life of that asset. Number 3, the PV factor we need to use. Simply, value of an asset is present value of future cash flows discounted at a required rate of return. When I call future, that future will be decided by the life. So three very important elements. What is the three elements? One is a cash flow, another one is a PV factor, third one is the life. Life I can also call it as time. Cash flow I can also call it as money. When this time meets money, we call it as time value of money. That's how the concept of time value of money has been originated. Time decides your money value. Okay, how come I can relate this time to money? How can the money value will increase or decrease as per the time? Using a component called as discounting factors. Popularly we call them PV factors. So let us first understand one important thing. PV factor calculation, cash flow analysis, life calculation. These three are very, very important elements of any kind of asset valuation. I am not going into dividends concept now. First, let me explain the cash flow analysis very clearly. Once we are clear with the cash flow analysis, we go with the dividends impact on the cash flows using the concepts of time value of money. So, if the question is, why this particular chapter? This chapter separately is not there in the study material. Nowhere in the study material you will find a chapter with the name cash flow analysis and dividend impact. But it is very, very important for anyone to understand this particular chapter before they start financial management. Whether it be normal session, whether it is a crash session, first this lecture will be for 1 hour. In this 1 hour lecture, we will be understanding clearly about what is a cash flow, why financial management considers cash flows, what is the dividends, how it impacts the share if you understand. From the next chapter onwards, we will start with the share analysis, also called as a securities analysis and valuation. So let us start with the concept. Why this chapter? This chapter analyzes three most important elements. Which decides an asset value. What is that? Three elements are there. Number one. The element number one is cash flow. Number two, life. Number three, PV factor, also called as discounting factor, also called as required return. These are the three very important elements, because value of any asset is present value of future cash flows discounted at required rate of return. Here, three very important words are also used. One is a cash flow, another one is a present value being a RR value, and the word is future. Future always determines the life. Okay, life can also be called as the time. Cash flows other name can be money. How come this money will get impacted with time will be decided by a factor called as required rate of return. So how the required return is going to impact my money cash flows over a period of time is called as a time value of money. I am not going to explain every concept of time value of money at CA final level and waste your time, but basics of time value of money is always important, imperative and prerogative for me to explain you very clearly at least some bare basic level of understanding the time value of money. At the end of this particular session, definitely everyone listening to the lecture will know that I learnt at least 2-3 concepts which I don't know in the basics of financial management. That means this is a session which will help us to understand certain easy concepts which we generally ignore and move on. There we are going to analyze in this session. I'm not going to re-explain the cash flows, re-explain the time value of money which you learned at CA CPT, which you learned at CA Inter, and again waste your time. No. This session, I'm not going to explain what you already learned. In this session, I'm going to explain the concepts which will be definitely new to you. What is that much new? Let's try to understand. So, why this chapter means this is the point. Next issue. After that. Question number 2. Question number 2. So first one, why this chapter? And that is answered. Various types of cash flows and corresponding PV factors. Let me explain this concept. See here, asset. We can divide assets into two categories. One is a real asset. Second one is a financial asset. Financial asset is further bifurcated into two parts. First one, equity and debt. Real assets like land and building, etc. etc. I'm not just telling land and building. It may be land and building, it may be vacant land, it may be anything. Okay. So these are called as real assets. So let us understand the concept now. Whenever I call a real asset, land and building is a real asset. Okay. Now listen carefully. Land and building to value, we require three elements. Element number 1, we require cash flows we are going to generate. We require estimated life of this building. We require required rate. Okay, I will explain this much clearly. Let us first write down. After that, with the numericals, with examples, I will explain what I am going to explain now. Sorry, next one, equity. Also three things. Debt, also three things. Okay, so the first one, in case of equity also, I require three information: cash flow, life, required rate. Cash flow, life, required rate. I come from the debt point of view first. Easy to understand. The most easiest asset to analyze is a debt instrument because of various good reasons. Reason number 1, why debt instrument analysis is easy when compared to the remaining instruments. First reason, cash flow is absolute. Means what? When you are issuing the debentures itself, okay, you will tell I will pay 10% cash flow, I will pay 10% coupon interest, 12% interest. This will be in the form of interest. Life of a particular bond, this is also absolute. What is absolute? 100%. when we are issuing the bond itself, we will tell that this is a 5-year bond, this is a 10-year bond, this is a 15-year bond. Like that we will tell. Even Companies Act also will promote the same. The bond life must be there. Irredeemable bonds, generally the Companies Act also don't entertain. So, bonds may be either secured or unsecured. That's an entirely different story. But Companies Act also will not promote the issue of irredeemable debentures. There will be a life for every bond. Okay. So, absolute. Where it will be there? Life of a debenture will be there in the trust deed and also in the issue document. Required return. The required return on the debt we call as KD. Call it as what's a KD. KD means what? Cost of the debt. Cost of what's a debt. Cost of debt. This is also called as yield to maturity. In this, these two are absolute and the last one is approximated, because last one is a YTM. YTM means what? The expectation of the market. The expectation of the market we can only approximate it. Exactly we can't tell. Everyone is expecting the same thing. Almost approximated YTMs we can do. Even in the stock markets, YTM calculations have been already done and the values are also available for government stocks and other things. Okay? Okay, let us start. Now let us come to land and building. What is a cash flow that a land and building can give? This is absolute because you will only decide the cash flow. This can be rent or lease, something like that. Life. Life is almost absolute. Means what? If I tell 40 years life of a building, 40-year completed means building will not demolish as if there is an earthquake. Absolutely, there will be no cash flow that can be generated until and unless you put some capital expenditure on it. That's the meaning of almost absolute. So, it is almost absolute. Required return is a query now. In CA Inter, we will be having a chapter called as cost of capital, where you will be learning about a concept called as weighted average cost of capital. So exactly what do you mean by a weighted average cost of capital? Weighted average cost of capital means it is not just equity, it is not just the debt, it is a blend of both of them. Okay, so it depends. What is your required return? If I purchase my building using entire equity or my own funds, I will call RR as KE. If only through the debtor, I will call RR to be KD. If I use both the blend, what we will generally do, whenever I want to purchase any building or any land and building, what I will do, I will go to the bank, I will make some down payment, own money, remaining 60 lakhs or 70 lakhs, I will put a EMI. Means you are not just putting your own money, you are not even just putting your loan money, it is a blend of both of them. Therefore, whenever capital budgeting decisions are taken, what budgeting, sir? Capital budgeting decisions are taken by the company, always we need to remember one thing. Companies will generally use the blend of debt and equity while putting the capital budgeting decisions. Therefore, in capital budgeting problems in CA Inter, if you remember for sake, you will use WACC calculations most of the times for calculating PV factors, because companies will invest both equity and debt when financing an asset, such that revenue from that will be given to both of them. Clear? For financial leverage sake. What is the financial leverage and all the other things I will explain very clearly. Okay, sir. Required rate, it depends. Most of the times it will be weighted average cost of capital, because we don't just involve one funding, we will involve a blend of funding. Okay, next issue. When it comes to the equity financing, very important and very difficult thing is the equity. Do you know why? Cash flows are probable cash flows. Means what? What is a cash flow on a share? Dividend. Dividend may come, dividend may not come. Therefore, first problem with the cash flow. It may come, it may not come. I can't give a guarantee that purchase this share, every year you will get 5 rupee dividend. Means if company don't propose a dividend, shareholders don't declare a dividend. If shareholders don't declare a dividend, I don't get any dividend. How can you tell that definitely I will get a cash flow? You might give a guarantee that there is an appreciation, but you can't give a guarantee that there will be definitely a cash flow on your stocks. Probable. Life. Life is one of the most debatable issues, perpetual. What is it, sir? Life is perpetual. Perpetual lives are there. Perpetual life means what? What is perpetuity? Perpetuity means there is no end, is not the thing. I don't know the end. Sir, I didn't understand. Sir, I will explain in much more easy sense. You should not call perpetuity means there is no end. There will be end for everything which is already started. Kingfisher company is there once upon a time. Maybe today, and in future if it is wound up completely, company A will not be there. Satyam company is there once upon a time. Now it is not there. So many companies have come to India. Many companies have been liquidated as well. Then how can you tell that forever? Perpetuity does not mean forever. Perpetuity means there is no end. No. There is an end, but I don't know the end. When you don't know the end, don't tell that this is the end. Therefore, we presume that it's a presumption. It's a presumption or a assumption. That's why it is also called as a fundamental accounting assumption. We presume going concern. Really, whether company will be there in the near future, who knows? No one know about that. So therefore, life is a perpetual life which you can't exactly tell what is a life. Building the life is almost accurate. Debenture life guarantee 100%. But in case of equity, life is also problematic. We don't know. Probable and perpetual. Required rate. This is more and more difficult because equity stocks will move up and down in a particular business day for around 1 crore times. Up and down they will move like a monkey. Therefore, how can you exactly tell that this is a return they are expecting? If they are expecting a fixed return, prices should be fixed always. Their return, their mindsets are changing the stocks. Therefore, required return will be called as KE. How this KE will be calculated? For this KE only, we have complicated portfolio theories. The chapter portfolio theories and asset pricing models, like portfolio management chapter we popularly call, there we have so many models to calculate KE. One such concept will be capital allocation line, capital market line, CAPM model, characteristic market line, for that case Sharpe's single index model, arbitrage pricing theory. Like that, so many concepts are there in hand which will make the calculation of KE at least to some extent theoretically. Okay, so in these three instruments whatever we have seen now, which is the most complicated asset? Obviously the equity. That becomes our first chapters. That becomes our first area of discussion. Land and building, real assets, anyway we don't discuss in our subject. Next one is a financial asset. We discuss about that completely in our SFM syllabus. Equity and the debt is our discussion part. Financial asset is our discussion. In our subject, we are not going to discuss anything about the real assets. We are not going to discuss about what's a real assets. We are not going to discuss. We are discussing only on what? Financial assets. Financial assets, the first one is what? Equity stocks. Next one is the debt stock. As I already given in the introduction lecture, okay, as I already said in the introduction lecture, equity stocks if I take, there are so many chapters in that. Okay, now see the screen and tell me, equity value will be influenced by three elements. Number one, cash flow. Number two, life. Number three, required rate. Number one is the cash flow. What is the cash flow that comes from the equity? Dividends. That means dividends are necessarily impacting the equity prices. Therefore, my chapter's name is dividends impact. Therefore, one must understand how dividends are going to impact a share before we start with our subject related discussion. Therefore, I said the first 1.5 hour session is not on the syllabus contents, pre-syllabus contents which one should have a clarity on in order to understand the remaining portion. Clear? So let us start and begin with the other analysis concepts on dividends. See here, I will give you 2-3 examples. So the next concept is time value of money in a nutshell. Means I don't want to waste your time by explaining everything from CPT or IPCC. Main concept from our discussion point of view. What really a time value of money means. As you already see on the screen, the concept where money derives its value and gets influenced by the lapse of time is called as a time value of money. Maybe if I tell in a technical language, so many can't understand, so I make it more simpler. Time value of money means by the passage of time, money value may either increase, may either decrease. When it increases, when it decreases is a query. There are two types of impacting time value of money concepts. One is the concept, whatever you are seeing here, discounting. Another one is a concept of compounding. Discounting factor and compounding factor are two very important concepts which we have to understand. Discounting is a process of bringing the future cash flows to the present. Compounding is a concept of taking the present cash flows to the future. I repeat, everyone see the screen once. Discounting is a concept of bringing the future cash flows to the present. Compounding is a concept of taking the present cash flows to the future. So as you see in the diagram as well, when the future cash flows are coming to the present, we call it discounting. When the present cash flows are moving to the future, we call it compounding. Present value will reduce the future cash flows value. Future cash flows will increase the present cash flows value. Simply to tell, value of something which is received in the future, what will be the value today is a discounting. What I receive today, if I invest for the future, how much I will realize in the future will be always future cash flows being a compounding. Compounding is a concept of taking the present cash flows to future. Discounting is a concept of bringing the future cash flows to present. These are the two very, very important concepts one has to understand. So, what is the most important element in time value of money? Time value of money will have one very, very important element called as a PV factor. What factor? PV factor. PV factor, if you use, you can use it for two purposes. You can use PV factor for discounting. You can use PV factor also for compounding. Okay. I'm not going to complicate the issue, just the formula what you already know, I will write down. Okay. What is that formula? Future value equal to present value into 1 plus r whole power n. That means we are multiplying here. We are multiplying the present cash flows or present value cash flows with some rate of return, making it to the future. It's called as a compounding concept. Present value equal to, using the same formula, FE divided by 1 plus r whole power n will bring the present value. We call it as discounting concept. So there are two concepts. One is a compounding, another one is a discounting. Compounding is a concept of taking the present to future. Discounting is a concept of bringing the present value, bringing the future value to the present. So present value to the future is called as compounding. Future value to the present, we call it as a discounting. These are the two basic formula we already seen. CPT level, IPCC level itself, you might have already done this. So I don't want to emphasize on that. Just that much is required. Now we need to understand, in most of the problems we will see PV factor equal to 12%, 14%, 16%, like that we will see. How these are calculated and estimated by a company is a query. This requires lot of financial management analysis, portfolio theories and asset pricing models. International capital budgeting, there is a concept. In international capital budgeting, there is a concept called as international fixtures effect. In that international fixtures effect concept, we will really understand what is a PV factor in its truest sense. Okay. As of now, we will be understanding first basic idea behind the concept of time value of money. So, whenever we see so many problems in financial management, we use PV factor at the rate of 12%, 14%, 16%, like that we will see. But how these numbers have come? Basic analysis I will explain now. The real meaning of PV factors we will see in a concept called as international fixtures effect. International capital budgeting in IFM. There we will understand really the meaning of how the PV factors will get influence. Now whatever I am discussing is a basic clarity only. Don't stick on to this to the finalization. This is only a basic clarity. Okay, see that. PV factors are made of two different important factors. Number one, opportunity cost. Number two, inflation. Opportunity cost will form part of some situation. That means in that 16%, some amount will be opportunity cost and the balance amount will be because of inflation impact. Let me explain how it will be. Say for example, I have 1 lakh rupee with me. I have 1 lakh rupee with me. With that 1 lakh rupees, I went to State Bank of India. State Bank of India, if I make a deposit, it is a risky investment, risk-free investment. It is a risk-free investment. On that risk-free investment, I will get 6% FD. How much percent? 6% FD I will receive. So listen carefully. 6% FD I will receive if I invest in SBI. Okay, now listen. I don't want to invest in fixed deposit. I want to invest in a chit fund company. I want to invest in a chit fund company. That means I am putting my money into a risky investment place, risk-free investment place, risky investment place. Since a chit fund company is a very, very risky investment, I don't just ask 6%, I will ask more than 6. Okay, sir, more than 6 also you are not asking. What you are losing because of not investing in SBI? 6%. First, this chit fund should give you that 6% return. I repeat, for example, opportunity cost means what? What you are foregoing, what you are losing is called as opportunity cost. Because of investing your 1 lakh in chit fund company, by not investing in SBI, you are losing a risk-free component or not. If you would have invested in SBI, pakka 6% you would have got. That 6% you are putting in a risk and investing. Therefore, chit fund company should first give you that 6%. Number one. Plus, you are investing 1 lakh rupees in a chit fund company. Okay, 1 lakh rupees in a chit fund company. If you invest 1 lakh rupee in a chit fund company, that 1 lakh rupees is blocked for 1 year. That 1 lakh rupees is blocked for 1 year. Once it is blocked for 1 year, after 1 year you will receive back your money. That means after 1 year when you get back your money, okay, if they give only 1 lakh back to you, what is the problem? Prices of a product which is 1 lakh today will not be 1 lakh after 1 year. It will be more than 1 lakh because India is subjected to inflation. 2-digit inflation in reality. For example sake, I will take 8%. Okay. Say for example, inflation rate in India is 8%. Means what? A product which is available at 1 lakh today will not be available at the same 1 lakh after 1 year. It will go to 1 lakh 8,000 for example. Okay. So now answer, if I invest in a chit fund company, my 1 lakh rupee is blocked for 1 year. Because of blocking this 1 lakh for 1 year, when I get back after 1 year, the same 1 lakh, what is the problem? A product which I can buy at 1 lakh 1 year back, I couldn't purchase at the same 1 lakh after 1 year. There is an inflation rate. Therefore, I should also ask the chit fund company compensate for inflation. Therefore, 8% they will give. So totally how much percent it is? 14%. This is how the PV factors are made. So how PV factors 12% will come, 13% will come, 16% will come, like this only they will come. But this is only a generalized analysis. More deep into this, a scientific approach itself is there that will be called as international fixtures effect, where you will calculate the nominal rate, real rate and discounting rate or a money rate or any kind of rates that are calculating in that area. We will really understand the impact of a PV factor. This is a basic analysis. Okay, so now everyone summarize. PV factor will be having two components inside. One is a opportunity cost, second one is a inflation. Opportunity cost is the risk you are taking on the venture. Inflation is the purchasing power you are losing today. Both together, we will ask a PV factor of 6 plus 8, totally 14. You may ask 15, you may ask 16. That means what we have to understand, Kaushik Mukesh will be investing in a savings deposit. Will be investing in what's a savings deposit. If I invest in a savings deposit, what is the point? I will not get 6. I will get only how much? 4. Therefore, my PV factor is not 14. My PV factor will be 12. Okay. For example, another person is there. Okay. Another person is there. For example, one of the students sitting now, Mr. Hanu is there. This person will be investing his amount in, okay, for example, Kisan Vikas Patra. He is very, very defensive. He is not at all an aggressive investor. He will be investing in defensive stocks like Kisan Vikas Patra, where his money will be blocked for 10 years fully. But Kisan Vikas Patra, as per the government recent regulations, will be paying around 9.12% return. That means 9.12% is a fixed return he will get, risk-free. Government, central government, he will give the return. For him, PV factor will not be 6 plus 8, it will be 9 plus 8, being 17% totally. That means these PV factors will be same for everyone, will change for everyone, will change. According to the appetite of the risk, this will get changed. But the point you have to understand is, this will not change across the investors because inflation is not an investor specific, it's a country specific. So, inflation for Kaushik Mukesh is 8, inflation for Mr. Raghu who is sitting in the class. Okay, another one. So, that person, his particular inflation rate is different. Like that, different inflations will not be there. Inflation is for a country, opportunity cost is for a person. Therefore, two important elements will bifurcate always. Inflation and opportunity cost are two various components which decides the PV factors. This is a basic analysis only. I'm not telling that this is the only reason for PV factor. This is a basic idea. A layman also can understand with this example. More scientific approach, international fixtures effect, we will see that in the international financial management, international capital budgeting. Now let us understand the next part. PV factors, how they will be derived, how the percentage will be, we understood. Okay. When you apply those PV factors on the cash flows, okay, when you apply the PV factors on the cash flows, you will get the amounts. You will get the value of an asset. Try to understand. So the next concept, why financial management subject rather than profits. So listen, why financial management subject considers cash flow. Value of an asset is present value of future cash flows. Why not future profits or future revenue? Why we call it cash flows? Why can't we tell present value of future revenues? Present value of future cash flows. Why? For example, even when you see the capital budgeting problems, columns will be like this. Here, cash flow, PV at the rate of some percentage, and PVCF. Okay. So, year 1, year 2, year 3 they will write. Some cash flows they will write. Here also they will write only the cash flows. Why only cash flows? What is the superiority of the cash flows over the profits? A reason should be there or not. Let me first summarize this concept and explain. After that, we will write the notes in this regard. Okay. Let's see here. Why cash flows are considered? Why not the profits? Let me explain the concept clearly. Reason number 1. Reason number 1. Accounting assumptions. Means what? When you take the element called as a profit, profit is a element which is derived from the account books. Okay. In calculation of this profit, there will be calculation of depreciation, provisions, many other things will go inside that: accounting estimates, accounting assumptions, real cash flows, and only notional cash flows. Many things will go inside the profit. Therefore, many accounting assumptions will decide the profit, which changes from person to person. Sir, what does it mean? I will explain you with one example. See the screen once. So the point is, for example, Mr. A is a chartered accountant 1. Mr. B is a chartered accountant 2. Mr. A followed WDV in depreciation. He followed SLM. He has taken life of 5 years. He has taken life as 7 years. And this particular person has taken FIFO valuation of stock. This person has used a weighted average valuation of stock. Bad debts as a percentage, they have taken 10% provision. They have taken 2% provision. Now answer WDV SLM, choosing between differences. 5 years and 7 years. FIFO weighted average. 10% bad debts, 2% bad debts. For the same company. Company same. Company is X Limited. X Limited, if you give to two chartered accountants, both the persons can't give the same report of P&L. They may give a different P&L report. Means what? Profit under this is X, means profit under this will be Y. That means across two persons, you will have a same profit, different profits are different profits. I don't want financial management to be inaccurate on the cash flows calculation. To some extent, it should have some certainty. Therefore, person specific amounts should not influence the stock markets. Person specific concept should not influence the financing decisions. Therefore, we will not consider these profits, because profit is based on many elements which is a person specific. According to his assumptions, profit will come. Okay, I don't want that to happen. Therefore, what financial management consider? Cash flows. Now you may ask a question, sir, cash flows la everyone will have a same amount of cash flow na? Now I will show you an example. See here, I have two 500 notes with me. Say for example, I have two 500 notes. I have taken these two notes. I gave to Mr. A. I asked him, count these and give me how much amount is there. A has taken and said me, sir, two 500s, 1000. I gave these two 500 notes to Mr. B. I asked him, please tell me how much amount is there. He also said 1000 rupees. Like that I gave to 1000 persons. 1000 persons after taking it, subject to condition, they didn't take back anything. Okay, they gave back me 1000 rupees will be there in everyone's calculation. This is cash flow. These are profits. Cash flows are certain for everyone. Profits are uncertain for everyone. Cash flows will be same for everyone. Profits will not be same for everyone. Cash flow don't have assumptions. Profits have assumptions. So therefore, I need an element which is away from all the accounting assumptions. Therefore, SFM considers, or financial management subjective will consider the cash flows, not the profits. Reason number 1. Next, reason number 2. Why cash flows are superior? Please listen. Why cash flows are superior to the profits? Why cash flows are superior to the profits? Why financial management often uses profits, by why it does not use, often uses a cash flows, and why it does not use the profit? There should be some reason behind that. So what should be that reason? Let's see the screen. For example, profits can't be reinvested. Cash flows can only be reinvested. Okay? Profits cannot be reinvested. Cash flows only can be reinvested. Therefore, financial management considers cash flows. Now you will get it out. Sir, what is this reinvestment concept, sir? So, let me explain. I go to a CA, qualified chartered accountant in practice. CA Mr. X. I went to him. I asked him, sir, prepare me a P&L account. I gave my books of accounts. I gave my vouchers. I gave my entire documents to him. I asked him, using this info, prepare a P&L statement for me. He prepared P&L account, depreciation, provisions, everything was put on according to the standards of accounting provided by section 133 of Companies Act. Using all the accounting standards, he lastly gave me a profit after tax as, say for example, 10 lakh. How much? 10 lakh. And he also signed, chartered accountant signed, stamped, membership number also given. Officially this is allowed by ROC. Okay, it is fileable under the MCA. So now this is a P&L statement. I have taken this P&L account, went to the bank. I asked the banker, sir, please take this P&L account, deposit this for at the rate of 6%. Fixed deposit of P&L account. I said, profit is there, please reinvest. He said, sir, where is the profit? Please give me cash, I will deposit. No, profit is there, na 10 lakh profit. Please invest. He said that, sir, profit is on a paper. It's not really happening. That's the reason. Profits are not realizable amounts. Profits are only amounts notionalized on the documents. Profit 10 lakhs means really in the hand, I don't have 10 lakh rupees. It has so many accounting assumptions inside. Profit can't be reinvested, only cash flows can be reinvested. For example, I go to the bank. I said, sir, 5 lakh, 5 lakh. Say for example, 2 checks, 5 lakh, 5 lakh. I gave to the banker 5 lakh checks. Liquid cash. Liquid cash means there are two types of cash. Physical cash, liquid asset means immediately convertible into cash. I gave these 2 checks of 5 lakh each to the banker. I said, invest in the FD at 6%. Immediately he will feel happy, take the money and reinvest. That means cash flows are reinvested, profits can't be reinvested. Because of that, financial management considers cash flows over the profits. Cash flows are superior to the profits. Okay, this is the reason number 2 why financial management considers cash flows but not the profits. Okay, so reason number 1, assumptions which changes across the person. 500 means for 1 crore people in India also 500 makes 1000 only, but 1 lakh chartered accountants will prepare 1 lakh different P&Ls. Second one, as I told you now, this is a reason number 2. Now question arises, sir, why you are concentrating on this reinvestment? A question arises or not? Profits can't be reinvested. Why reinvestment? Listen carefully. I will go to LIC. LIC person will tell you take the home loan at the rate of how much percent? 8%. Or put in this particular deposit. Banks, chit fund companies will also tell, put in this chit fund, you will get 8% return. In this, lot of scam will be there. What scam will be there? I will explain. Say for example, you will receive 1 lakh after 3 years. You will receive 1 lakh after 3 years. Your required return is 10%. Your required return is how much? 10%. You will receive 1 lakh now after 3 years. After 3 years you will receive 1 lakh. Your required return is 10%. Now, how much you should invest today such that that amount will producing that 1 lakh rupee after 3 years? Hope you can understand the question. How much X amount you should invest today at a 10% rate to get 1 lakh after 3 years? How much we need to invest? That's called as calculation of present value. Okay, let me explain why suddenly we are diverting to reinvestment concept with this example. In just another 2 minutes you will understand what is the importance of reinvestment in financial management. Okay, let's see here. Future I want to get 1 lakh. I want to get 1 lakh in future. My required return is 10%. How much present value I need to invest such that my future value is 1 lakh? So in an easy way I will tell, year, cash flow, PV at the rate of 10%, PVCF. Okay, I want to receive how much? After 3 years I want to receive 1 lakh. So PV factors I will calculate 10% rate. 0.751. So how much? 75,100. Clear? That means if you invest 75,100 today at a 10% rate, it will mature to 1 lakh after 3 years. This is a general tendency. This is a scam. This itself is a scam. How this is a scam? Let me explain. You got how much? You invest how much? 75,100. When year 0, you invested 75,100. How much interest? 10%. How many years you will get? 3 years. Means 75,100 into 10%, 75,010 into 3 times you will get 22,530. Total will be 97,630. It's not 1 lakh. It's not 1 lakh. It's only how much? 97,630. It will not be 1 lakh. So now what we have to understand, this is not the way in which you have to calculate this. How to calculate this I will explain. Year 0, you invest 75,100. You will get an interest of 10%, 75,010. Add both of them. 75,100 plus 75,010 will make 82,610 plus interest again 10%, 8261, 90,871 plus again interest at the rate of 10%. Okay, it will be 99,958, almost approximated to 1 lakh. From this, what you have to understand? Chit fund companies will tell, we are giving a return of 8%, not interest of 8%. They will not tell I am paying interest of 8. They will tell we are giving a return of 8. Return is a PV factor. Interest is a cash flow. Both are different. So what chit fund companies will tell? We are paying a return of 8%. Means what? I will be giving you 7,510. If you reinvest this amount at the same 10% with us again, then only you will get this 1 lakh after 3 years. Directly every year 75,000, 7,510 came. You eat away the amounts. It will not be 1 lakh after 3 years. That means what is presumed inside this 10%? Reinvestment. That reinvestment is possible not for profits. Reinvestment is possible only for what? Cash flows. Therefore, cash flow, if it comes, you can reinvest. Profits, banks will not accept. Chit fund companies also will not accept. You take the P&L account and go to chit fund company, deposit this chit fund company and pay me dividend, they will not pay. What can be reinvested? Cash flows can be reinvested. That means the PV factor will be applied on cash flows. Those cash flows should be real cash flows, but not the profits. Therefore, financial management considers cash flows. Reason number 1, assumptions. Reason number 1 is a difference in opinions of profit calculation. Reason number 2 also explained, where profit can't be reinvested. There is a reason number 3 as well. Reason number 3, what is this? Inflation impact. Inflation impact. For example, SBI la if I invest, investment is a risky investment, risk-free investment. Investment in SBI is a risky investment, risk-free investment. It is a risk-free investment. No risk in investing in SBI. So if you invest, I'm not talking about SBI stocks, I'm talking about SBI fixed deposit. Risk-free. Even the risk is not there, why SBI will pay 6% or 7% to you? To tackle inflation, not the risk. SBI fixed deposit paying 7% means why it is paying you? It is not paying because there is a risk. It is paying because that amount is subjected to inflation. To tackle the inflation, they will pay the interest. Okay. Now listen carefully to the last conclusive reasoning. For example, I go to a bank. I gave this 10 lakh rupee to the banker and said deposit. After 1 year, SBI will give me same 10 lakhs, will give 10 lakh plus interest, 10 lakh plus interest to tackle inflation. To tackle inflation. Okay, now listen. I kept my phone in SBI Safe Locker. Same 1 year. Same 1 year I kept a SBI Safe Locker. Okay. After 1 year, will they give me another AirPods along with Apple iPhone since I kept it for one full year? They will not. This is a product. This is the cash. Cash is subjected to inflation, not the products. Profit is a product, because profit inside depreciation is there. Depreciation, why it will inflate? Depreciation will deflate. Depreciation comes down. Depreciation will not inflate. Fundamental bad debts will be there. Why bad debts will have inflation? Inflation will not impact bad debts. Bad debt is the intention of the person. It is not inflated. So profits, so many elements are there which you can't apply inflation element on that. But cash flows are not like that, are subjected to inflation. So for example, Apple phone, okay, inflation of 10% affected Apple phone. Means what? 10% inflation on Apple phone means Apple phone size increased. No, cash required to buy the Apple phone has increased. That means inflation will affect what? Cash flows, not the profits. That's why financial management always uses cash flows. That's why what is the cash flow on the share? What is the cash flow given by a share? Dividends. Therefore, dividends are impacting the share prices. That's what our first chapter is. The impact of dividends on the shares. Okay. So, the first chapter which we are going to start is the impact of dividends on the share. Once we understood, I will take quite a good number of problems, like 4 to 5 problems only, because it's not there in our syllabus, dividends impact. But there are 2-3 problems taken from share valuation chapter, from which I will explain dividends impact in a different view angle. Once I make it clear in another 1 hour session, then we will go impactively into the chapters discussion with a chapter called as securities analysis and securities valuation. Already in one of the previous videos I said na schedule of our classes, clearly according to that chapters only it will go. Okay. So why financial management subject considers cash flows rather than profits? Simply in 3 words we can tell. Reasons. So what are the reasons? So as I already written, there are totally 3 reasons why financial management considers cash flows rather than profits. Reason number 1. Profits are based on assumption of the person who prepares it. Reason number 2. Profits cannot be reinvested. Reason number 3. Reason number 3. Profits are not subjected to inflation. Therefore, what is considered? Cash flows are superior. Last discussion for this lecture. When I use the term cash flows, there are 4 types of cash flows. Single cash flow, multiple cash flow, annuity cash flow, perpetual cash flow. Single cash flow look like this. Year cash flow. Now I will invest. After 10 years, I will receive some cash flow. This is a single cash flow. Sir, example. I will give two examples. One is zero coupon bond. Second one is a LIC policy maturity. You will pay, but you will realize only in the future. One cash flow only will come, maturity. Okay, this is it. Next. Multiple cash flows. Year cash flow. Year 1, 2, 3, like that they will come. Year 1 la one cash flow, year 2 la another cash flow, year 3 la another cash flow. This is multiple cash flow. Capital budgeting problems will come under multiple cash flow category. Next one. Annuitizing the cash flows. Okay. Multiple, annuity cash flows. So this one. Year cash flow. Here also in annuity, multiple cash flows will be there. But multiple cash flows are same cash flows. What does it mean? If you see the multiple cash flow second category, these are multiple, no doubt, but these are uneven. These are even. Means what? 1 year I will get 1 lakh, another year I will get 2 lakhs, another year I will get 1,20,000, another year I will get 70,000. Like that this will be. Annuity means you will get multiple cash flows, but only a common cash flow will come. Even cash flows will come. Therefore, notation will be like this. 1 to 10, same cash flow will come. Okay. Next one is perpetual cash flow. A long discussion will be there. Discussed in dividends impact concept. Discussed in dividends impact concept. Separately, we will discuss about that. Okay. Perpetual cash flows is separate. Why? Share is dependent on a company whose life is perpetual. That means share will be there till company is there. Company will be there till perpetuity. Means a share will be there till perpetuity. Share gives a dividend. Dividend also will turn till perpetuity. Therefore, the cash flows are perpetual for a share. Those are called as a perpetual cash flows, which we will see in our first chapter, dividends impact. Okay. With this, I am closing the first lecture with regard to the fast track batch and also the regular batch. This common video is for everyone. Okay, from the next concept onwards, the fast track sessions will be on a different pace. We will be completing in a fast pace only. So as I already said, this 130 hours of the session will give huge clarity on each and every concept. And don't misunderstand that just the basics are like this. Every concept will be having a background analysis better than that of law, because this is my favorite subject. So we will be covering out all the important concepts inside this with the reasoning and background analysis, not just mechanically, robotically doing the questions and answers. Okay. Please, I need your support. Follow up to our friends as well. Please convey this about the classes. Thank you very much. I'm signing off. In the next session, we'll come with a different concept.